Hello and welcome to the session in which we will discuss the cash collection cycle. Now, to be specific, we can receive cash in so many different ways: through issuing stocks, borrowing money, making sales. In this session, we are looking at cash collection from the sales perspective. So keep in mind, we are going to audit the cash account separately later on. This session deals with cash collection cycle from sales. So it's very important that you are familiar with the sales cycle. And if you looked at my prior recordings where we looked at the sales cycle, we said first we make a sale for 100,000, we debit account receivable, credit sales revenue. Then the customer pays their balance, we debit cash, credit accounts receivable, and basically account receivable is done. We recorded the sales and we recorded the cash collection. So in this session, all what we're focusing on is this here. Let me put it in a different color, not yellow. I was going to highlight it, it didn't highlight. We're looking at this cash collection when we debit cash from customers that they paid their account. First, we're going to go over the process, what are proper internal control procedures. Then we would look at the audit assertions that we need to deal with when we're auditing this process. So the cash collection cycle will follow the similar approach as the sales cycle. First, we would look at the internal control that should be in place, the proper internal control. We understand the proper internal control through inquiries, asking questions, flow chart. We assess the internal controls, especially if we're going to rely on them for public companies. Then we test the control. So first thing is the internal control, which we'll talk about the internal control. Then we'll design the test for the control to evaluate their effectiveness. Then we will develop substantive testing to meet the audit assertions, the completeness, the accuracy, the occurrence for the cash cycle. So we'll do the same thing as we did for the sales cycle, but here it has to do with the specifically not cash collection cycles as part of sales. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Hello, my name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great. You are looking for some additional help, and we can help you. I strongly encourage you to visit my website, farhatlectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website.
First, let's take a look at the big picture. How does this process begins? It begins when a company receives payments from customers and conclude when those payments are recorded in the accounting system. It really concludes when the money makes it to the bank, but basically once we record it from an accounting perspective, we have it. So the steps would include first, receipt of payments. Payments are received via cash. Checks, what we mean by cash is really checks, and electronic transfer. If we received a check, we immediately endorse for deposit only to called its restrictive endorsement. This way, if the check is lost or stolen, no one can use it. Then we prepare a pre-listing of cash receipts. This is part of the document process where we put the name, account number, and the amount of the customers that paid, and we send this to the accounting department to update the record to track the amount. Then we prepare the deposit slip. Deposit of cash and checks. Payment are sent to the cashier for bank deposit. Then from the bank, we would receive a receipt. The bank provide deposit receipt as proof of the transaction. The transaction is recorded and someone will overlook this process, making sure the money that we received made it to the bank, all of it, no more, no less. So this is basically the big picture, the steps through the cycles. Now we're going to look at some common concerns, then look at some internal control that applies to the cash cycle. Then we would look at the procedures, not the procedures, the substantive testing, the assertions that deal with the cash collection cycle. So what are the main concern with the cash? The first one is completeness. Did we receive all the cash, and did all the cash made it to the bank? So this is completeness is important. Was all cash received recorded? Because missing or stolen cash is a significant risk. If that money is not there, we cannot audit something that does not exist. So if a cashier pockets $500 and omit that from the pre-list of receipts, then there's nothing we can do. So first thing, we want to make sure all the cash is there, and we have to create internal control and substantive testing to make sure that's happening. 2 is accuracy. Is the amount correct? Recorded correctly? Also, misstatement can distort the financial statement, and the company could be losing money. So, for example, recording $1,000 payment as 100 due to a typographical error, this deals with accuracy. Well, that's not a problem. Accuracy we can catch if it's an error. If it's a fraud, it's more important. Also, what's important in the audit collection cycle is deposit reconciliation. Do recorded receipts match deposits? Whatever we received, it should make it to the bank. Any discrepancies could indicate either fraud or error. So simply put, when the company received the money, somehow they're going to input this number in their accounting system. Great, $500,000. That same day, that money will made it to the bank. Well, we're supposed to have in the bank also $500,000. So that matching should always be there, that reconciliation. So compare receipts in the journal to cash deposited at the bank. This is called proof of cash receipts. Whatever we debited cash in the accounting record, so we have an account called cash, and for that day we're gonna debit that amount a certain amount of time. We have to look at our bank account, and the same amount should increase our bank account, whether it's $500,000 or $500. It doesn't really matter. So a bank statement showing $4,500 deposit for that day, but the cash receipts reflect $5,000. It's a problem, because it shows that we received $5,000 but only $4,500 made it to the bank. Also, another concern is lapping, and we'll talk about lapping shortly. Lapping of account receivable, I will discuss it separately. Now, what are some common internal control to safeguard cash? Let's start with the internal control. First is you want to have to make sure we have segregation of duties, because you want to reduce risk, theft, errors. Remember, internal control, remember the fraud triangle. Rationalization and pressure. There's nothing you can do about rationalization. You cannot go into someone's mind. All the people are under pressure, financial pressure. But what you can do, you could eliminate the opportunity from the fraud triangle through internal control. So what are some common internal controls that will help us with the cash collection cycle? One is segregation of duties or separation of duties. No single employee should handle receiving, recording, and reconciling cash. So the person that receives the cash should not be able to record the cash, because if they can do both, they can steal it and cover their tracks. Person that's recording the cash should not be able to do the reconciliation, because they will tell you the money is there because they recorded it, and they're allowed to check if it made it there or not. Same thing with receiving. If someone is receiving the cash, should not do the reconciliation. So those should be separated so that the cashier deposits the fund, the accounting department record the transaction, do the recording, the cashier receive the fund, and an independent reviewer, a third party, do the reconciliation, checking to make sure what the cashier received, what the accountant recorded, made it actually to the bank through a third party. A third person is doing this. Mandatory employee vacation, and this is going to become important when I talk about lapping. You're going to see why. Employee handling cash must take vacation to uncover potential fraud. If you're handling cash, you should take a vacation, and the person that replaces you should be able to do the work if everything is working as it should be. During a teller's vacation, a substitute could discover any discrepancies in deposit record, and we'll talk about lapping shortly. Pre-listing of cash receipts, as I mentioned in the sales cycle. Once we receive the check, we write down the names of the person, the check number, their account number, how much they paid, and this is gonna meet the completeness, making sure we are accounting for everything. So a daily list shows 3,000 receipts and check should match the deposit, and assuming we have internal control for the pre-listing of cash receipts. When we open the mail, making sure that we have more than one individual opening the mail, there's a camera, and those two individuals should not be the same. They should be changed every once in a while so they don't become too friendly with each other. So those are part of the internal control of the cash receipts. Restrictive endorsement: as soon as the individual open the mail, take the check, turn it on its back, and endorse it for deposit only, so no one can take the check. There's no motive for someone to steal the check, because that's it, they can no longer use it. So a stolen check with a restrictive endorsement is useless for a thief. Also part of the internal control, sending monthly statements to customers, because if there's something wrong, the customer is going to tell you. So statements allow customer to verify their payments, because if someone's sending a payment and we are not posting their account and we send them a statement, they will complain. A customer dispute, a missing $1,200 payment, promoting an internal investigation will do the job. Independent reconciliation, always a great control. An independent party reconcile bank deposit with the cash general ledger. So the reconciliation process could identify a certain amount that's caused by either an error or, worst, fraud. Let's take a look at this multiple choice question from farhatlectures.com. All the following tests of control of cash receipts provide evidence relevant to completeness except. So we're dealing with completeness. We have 4, 3 are completeness and 1 is not. Observing whether pre-listing of cash receipt is prepared. Yes, that deals with completeness, because you want to observe this. This is part of your control. When it comes to completeness, that's out. Observing whether the statements are sent to customer each month. Yes, that's part of the control for completeness, because if someone is sending a payment, we're not posting the payment, they receive their bank statement, they are going to call us. C, observing whether checks are restrictively endorsed. Yes, restrictively endorsing checks. That's it. We have the check, no reason for someone to steal it. Would help with completeness. We're accounting for everything. So by process of elimination, D is the answer, and D is observing whether the accountant independently reconciled the bank account. That deals with accuracy more than completeness. So let's go back here. So independent reconciliation deals with accuracy. Independent bank reconciliation also deals with occurrence rather than completeness. So this is what you want to make sure you can differentiate between all these assertions. How would you learn more? You want to go to Farhat Lectures, look at additional resources, multiple choice. Whether you are an accounting student, a CPA exam candidate, I do have AI CPA previously released exam questions. Invest in yourself. Good luck and stay safe.